If you keep a savings account and you're over 60, there are three enforcement realities that the banking system and the IRS already applied to you. None of them showed up as a letter in your mailbox, no notice, no phone call. They're just sitting quietly inside bank compliance manuals and IRS filing rules that almost nobody outside the industry ever reads. Today I'm covering all three. The insurance number people assume protects everything, but doesn't. An everyday habit that can accidentally get an account flagged and a small stream of money most people never think to count as income, even though the IRS already has a form with your name on it. Stay to the end because the third one applies to nearly every savings account in the country, whether the balance is $2,000 or $200,000. Make sure to hit subscribe and turn on notifications right now because every week I cover the real financial information that affects seniors directly. The rules that changed, the protections you already qualify for, and the steps that actually make a difference. This is exactly the kind of content I put out every single week, and you do not want to miss it. Now let's get into it. Rule 1, the $250,000 figure only tells half the story. Most people with a savings account learned a single number, $250,000. Stay under it, and the FDIC has your money fully covered if the bank ever fails. That much is accurate, but it's only one side of the equation, and the other side has nothing to do with insurance. Every transaction that moves through your account, cash or otherwise, still passes through the same federal reporting framework that applies to any bank account, and savings accounts are not exempt. Under the Bank Secrecy Act, a cash transaction over $10,000 in a single business day requires your bank to file a currency transaction report with FinCEN, the Treasury's Financial Crimes Division. It doesn't matter if that money came from selling a truck, an estate settlement, or a relative handing you cash directly at a bank counter. The report goes out with your name, your social security number, and the transaction details attached, filed electronically within days, and you're never handed a copy or told it happened. Now to the insurance side, since this is where the real confusion sits, FDIC coverage is $250,000 per depositor, per bank, per ownership category. And credit unions carry the identical protection through the NCUA's Share Insurance Fund. So the number doesn't change if you moved your money assuming a credit union works differently. It doesn't. A married couple can often shelter well over $250,000 at a single institution by holding an individual account, a joint account, separately. Since each ownership category gets its own coverage, naming a payable on death beneficiary on a savings account can add further protection too. But if you simply deposited a $400,000 windfall, a home sale, an inheritance, a matured CD into one plain savings account, only the first $250,000 is protected. The remainder is exposed if that institution were ever to collapse. Retirees consolidating a large lump sum are the group most likely to cross this line without realizing it, simply because nobody flagged it for them. There's also a second report worth knowing about, and it isn't tied to any round number at all. It's a suspicious activity report, or SAR, and a bank can file one on any transaction of $5,000 or more that its monitoring software finds irregular, savings accounts included. You won't be told. It is a federal crime for a bank employee to tip you off that one exists, punishable by up to 5 years in prison. None of this means switching banks or hiding money in envelopes. It means understanding precisely what your balance is protected against and what your activity is being watched for. If your savings at one institution is near or above $250,000, that's worth a short conversation with a bank representative about titling and beneficiaries, using the FDIC's own online electronic deposit insurance estimator or the NCUA's equivalent tool, not because you've done anything wrong, but because closing that insurance gap costs nothing and takes a few minutes. Rule 2, an everyday habit that resembles evasion. This is where a genuinely sensible decision can turn into a flagged account without a single wrong intention involved. Take Robert, 69, a retired mechanic from Tulsa. After settling his late mother's estate, he had roughly $310,000 to deposit. Having read enough to worry about the FDIC gap, he decided to spread the money into his savings account gradually. 7 separate deposits over 5 weeks, each one comfortably below $50,000. Robert wasn't trying to dodge any threshold. He thought he was being careful, but a series of deposits arriving close together at similar amounts over a short window is exactly the pattern compliance software is designed to catch. His bank filed a SAR. He only learned about it when a compliance officer called to ask where the funds originated, and he was able to resolve it quickly because he still had the estate closing paperwork and title transfer records on hand. This pattern is called structuring, defined under Title 31, Section 5320F of the U.S. Code, and the law is stricter than most people expect. It does not require any proof that you intended to avoid a reporting threshold. A pattern that simply resembles an attempt to stay under the radar is enough to draw scrutiny, regardless of how legitimate the money actually is or where it came from. If you're moving a substantial sum into or across savings accounts, the safer route is a single fully documented deposit rather than several smaller ones. Bring the paperwork that supports it, the closing statement, the probate letter, the maturity notice from a CD. If splitting funds across institutions is genuinely necessary to stay within insurance limits, space the transfers out naturally over time rather than compressing them into a few weeks. And keep a short written note explaining the reason behind each one. Documentation, not smaller pieces, is what actually protects you here. So here's what I want you to do. The benefits, the discounts, the assistance programs most seniors qualify for but never actually use. My colleague Hank Mercer gathered them all in one spot, organized by state and by program, so you don't have to dig through confusing government websites for hours. It's quick, it's straightforward, and any senior can find exactly what fits their situation. No matter what state you're in, there's help out there you're probably leaving on the table. It's called the Senior Benefit Playbook, and it's sitting in the first pinned comment right under this video. Just tap it once, and you'll have everything you need. Now stay right here, because the last one is the exposure that quietly costs seniors the most money without them ever seeing it coming. And it's the reason I made this whole video. Rule 3, the money that never registers as income. Now to the rule that touches almost every savings account holder, whether the balance is modest or substantial. Interest. It arrives quietly, a few dollars credited every month, and it rarely feels like income. The IRS disagrees entirely, and the reporting threshold here is far lower than most people assume. Any bank or credit union that pays you $10 or more in interest on a savings account, CD, or money market account during a calendar year must issue you a Form 1099-NT with a matching copy sent straight to the IRS. Not $600, not $20,000, $10. With savings rates having climbed noticeably higher over the past couple of years compared to a decade ago, many retirees who moved funds into high-yield savings accounts for better returns are now generating meaningfully more reportable interest than they're accustomed to tracking, often spread across 3, 4, or more institutions chasing the best rate. Here's where the trouble starts. If your savings are split across several banks, each one sends its own separate 1099 INT once your interest there crosses that $10 line. The IRS then automatically cross-checks every one of those forms against what you actually reported on your return. Miss even one, say $35 in interest from an account opened years ago and nearly forgotten, and the IRS's matching system flags the discrepancy. What follows is a CP2 000 notice, not an audit, but a proposed adjustment to your tax bill, with interest charges and sometimes a penalty layered on top. Take Patricia, 71, a retired home health aide in Memphis. Over the years, she'd opened 4 separate savings accounts, chasing better rates at different banks. 3 sent her 1099 INT forms that she reported without issue. The 4th, an account with just $34 in interest that she'd nearly stopped thinking about, slipped her mind entirely at filing time. Roughly 8 months later, a CP2 000 letter arrived. The dollar amount involved was small, but the notice still carried a 60-day response deadline. And it cost her a genuinely anxious week before she understood exactly what it meant and how to resolve it. The fix is simple and doesn't take long. Before filing each year, gather every 1099 INT you receive and check it against a running list of every account you hold, including ones that feel dormant or forgettable. If a bank paid you interest but never sent the form, likely because it fell just under that $10 line, the income is still taxable and you're still responsible for reporting it accurately. The IRS generally has 3 years from your filing date to question a return, extending to 6 years if the unreported amount is large enough relative to what you originally claimed, which means a small gap from 2 or 3 years ago can still resurface as a notice today. Before you go, here's your action plan laid out in order. Step 1, build a complete list of every savings, checking, CD, and money market account you currently hold across every bank and credit union, old or dormant accounts included. Step 2, for any single institution where your combined balance sits at or above $250,000, review your account titling and named beneficiaries against FDIC or NCUA coverage rules, or run your numbers through their free online estimator tools. Step 3, when depositing a large lump sum, cash or otherwise, complete it as one documented transaction supported by paperwork rather than several smaller deposits spread across days or weeks. Step 4, each January, collect every 1099 NT you're sent and match it line by line against your full account list before you file, so nothing small slips through unreported. Step 5, if a CP2 000 notice ever lands in your mailbox, respond in writing before the deadline printed on it, typically 60 days from the issue date rather than the day you opened it, and include your supporting documentation. If the disputed amount exceeds $5,000, bring in a licensed tax professional before you respond. Step 6, keep a simple folder, digital or physical, holding your account statements, deposit records, and any large transaction paperwork for at least 6 years. It's the single easiest habit that turns a routine compliance question into a 5-minute phone call instead of a stressful ordeal. None of these 3 realities arrive with a warning attached. Your bank legally cannot tell you a SAR was ever filed. The IRS won't call ahead of a mismatch notice. That silence is built into the system on purpose. Knowing the actual rules and keeping the paperwork to back them up is what keeps a quiet flag from ever becoming a real problem. You are not most seniors. You just found out. The IRS is not going to call and explain what any of this means for your specific account. Your bank is not going to walk you through the Medicare SA trap before you file. The people who keep the most money in retirement are not always the ones who earn the most. They are the ones who were told what to check. That is the fixable part.